Welcome everyone to another issue or another edition, I should say, of Macro Matters, where we look at the macro that matters for our CFA Society of Chicago members and their guests. Here we are, fresh off the CFA Chicago annual dinner, and I'm joined by my co-hosts Blaine Reed and Tony Zhang. Uh, Welcome, guys. How was the annual dinner? I wasn't able to get there. I actually had to teach classes that day, but anything fun and interesting there?
Yeah, good to see you, Rich and Blaine. And Blaine and I met over there, and it was actually quite interesting and honored to actually celebrate this CFA Chicago Centennial annual dinner events right over there. And it definitely a lot of discussion and all focus on AI. I guess the AI's impact might be a persistent and continuous like topic that we will cover during our episode going forward. But I would actually like to hand over the token to Blaine.
Yeah. Hi, Tony. Hi, Rich. Yeah, it was well attended. Like Tony said, great to celebrate our 100-year anniversary here at CFA Society of Chicago, and a lot of energy. There was a lot of folks there. I think we were hitting close to pre-pandemic numbers as far as the annual dinner attendees. So that was good to see, and a lot of people that you might see once or twice a year. So that was fun.
That was fun. And the topic of conversation, we had a futurist speaking to us. You guys tell me, and talking about the future. Future includes AI. Maybe it's the last invention in the history of the world, as Tony likes to say. But right now, it's the invention that's costing everyone their jobs. Everyone from CFA charter holders to students coming out of college. Tony, we were talking about beforehand about the number of job losses announced just in the last week or so. I mean, clearly highlighting that was UPS and Amazon laying off quite a few employees. Amazon in particular, I think, talked about how AI was replacing their corporate jobs. But what do you, I mean, you've been on kind of the your finger on the pulse of AI in the labor market. What do you take from all the headlines that you're seeing in terms of the labor market right now?
Yes, I have been involved into the latest research about identifying the channel, how the firm with a different AI strategy would have a different impact over the allocation of the capital and resource inside the company and simultaneously having different impact over the corporate valuation. Apparently here we actually see two trends going forward. What people call it like a K-shape. One shape is that you see a very small group of company focusing on AI continue to see their market cap continue to go higher and higher, including Nvidia, like Apple, like Alphabet, Google in this case, right? And simultaneously, you see another group of company having right now have to adopt some of the AI, continue laying off the people, including Amazon, something like one as before the earning announcement of the Amazon last week. We saw that Amazon just announced they're going to lay off about 30,000 people, and suddenly a post announcement just like Amazon reached to all-time high, right? So you actually still see different corporated uh, uh, having different attitude to what about AI, but actually due to the different reasons over there, and apparently for all fall down to whether AI is a bubble or AI when the AI bubble would actually collapse. People like to pop. This is people like to discuss. I think there will be huge things over there, and we will see the AI adoption will accelerate it. I think starting even this quarter, and will continue to accelerate it until maybe even the end of next year. This is what the trend is telling, and then it's getting stronger and stronger. Now here, with so many people laying off, like thousands of people, as the Rich, you mentioned UPS 48,000, Amazon 30,000, Intel 24,000, Nestle 16,000, Accenture 11,000. You see it here. It definitely has a huge impact over the Federal Reserve, the interest rate policy, and simultaneously also whether how strong the U.S. consumer market will remain to be. That's I think this is also a big macro that we actually need to discuss right over here, and this is something I think need to not only investors also requires all of people get this society to pay attention to, including the policymaker as well, I think.
Yeah, I mean, even though there's clear signs and anecdotal stories and headlines like this about labor market weakening, um, Chairman Powell told us in one of the big things of last week. Last week was super busy, right, with earnings, with the FOMC meeting, and with the trade talks between U.S. and China. But one of those highlights was that Chairman Powell was saying um, that the Fed is, December is not a done deal. And Blaine, looking at that here, we can. I'm just bringing up the world interest rate probability screen on Bloomberg, and it shows that what was 92% odds or so for a December cut before the meeting has fallen down to 65%, and we've seen that kind of ripple throughout the curve. Um, and we've definitely see that if we kind of look in spite of that, I would say, post the FOMC meeting, now we're looking at the 10-year yield. Even you're seeing the odds ticking back up. So the bond market moving, the 10-year yield is moving higher, moving from below 4% to 4.11, and seeing some of the odds of a rate cut priced out doesn't seem to jive with the labor market weakening that Tony is talking about, Blaine. So what do you think is maybe kind of going into this?
Yeah, I think, well, first off, the chart you have up here, we did see the tick up in the 10-year kind of post the Fed announcement last week. I personally think a lot of that was due to just um, Chairman Powell's taking somewhat the high probability of a December rate cut. I don't want to say off the table, but lowered expectations for that. I think probably the 10-year just maybe repriced a little bit on the heels of that. But I think you have to ask yourself, why is he saying the December rate cut is not a foregone conclusion? And I still think that they're still, seeing inflation in certain parts of the data running still above what their target is, and you've had some tick up in some of the data. Now, the rates are certainly coming lower. The rate of change is certainly lower, but they're still battling this idea of inflation running above their target. Then you have what Tony just outlined as some of these uh, uh, um, job layoffs and cuts, and how much that's going to actually continue. That will be my questions, if we see that continue through the coming weeks, or this is just kind of one and done for now and see where things go. But again, kind of the rate of change there. What's going to be the real rate of change on these job numbers? Um, so I think he's still trying to counterbalance those two ideas, and the idea too, just at a high level, you would think that the lower they take rates, you run the risk of just kind of reinflating things. And I think there's been some talk about that. There are certainly some people out there in that camp who feel that if they go much lower, you could have a reinflation of some of the data out there, and then that's going to put them in another bind. So he's in a real tough spot, on top of whether or not he's going to be sitting in the chair, in May or not. So a lot of cross currents, I think, still out there.
Yeah, likely. I mean, who knows? But likely he's not going to be, and we're going to
Yeah.
have. We did get dissents in each direction, right? We had uh, we had Fed governors looking for, or FMC officials looking for 50 basis points, and we had some looking for zero, right? So we had dissents in either direction. It seems to be getting a little bit more political. Tony, we got the ISM data today, and we're not getting government data, which I think is good riddance, but ISM is probably better data and preferred data.
Mm.
Some want to point to the headline ISM manufacturing, which came in a little softer than expected at 48.7, but that's kind of counter to what we've seen from the S&P PMI, which better than expected, up at 52, and the regional Fed surveys, which have come better. And it's also counter to the new orders to inventory ratio, which continues to tick higher, and leads the ISM itself by a couple months. And so that's pointing well. And within the ISM data, the manufacturing data, or manufacturing survey, I should say, the employment numbers seem to be ticking higher here. In inflation's coming a little bit lower. So maybe that's why, if is this what maybe the Fed's looking at some of this ISM type data and thinking that maybe they don't need to be as accommodative, Tony, and things are just fine in spite of all this doomsaying that's going on out there.
Well, yes, as what Chairman Powell he mentioned that with the lack of the government data, it might be actually tough, or it might be better off like, for Federal Reserve to actually to slow down the federal rate cut path. But I don't think that's actually a good or solid argument. And as what we continue to outlay the like this I would say disinflationary nature of the AI adoption is going to actually undercut any potential like inflation momentums like over there that caused by either the tariff or other things over here as what we continue to see as more layoff going on, the demand would actually sudden drop. This is something I think the downside shock has not been fully estimated. Or to be more straightforward, there is currently no statistical model that can actually measure the upside or a downside shock caused by the AI adoption by the corporation. This is just because this is might be the really the last human innovation innovation here in the mankind, and after that, no one would know what's gonna happen. So here for Federal Reserve, even though it might be okay for Federal for Chairman Powell to take a wait and see approach as outlined by Blaine, but here more people are suffering, and then it will actually the faster that Federal Reserve can lower the interest rate because the after the hawkish comment from the Chairman Powell, apparently market interpreted as hawkish. Instantaneously, small cap stock actually fell off, that actually causing a lot of issue. And that simultaneously, the large cap actually rebounds very nicely. It continue to reach into all-time high because they are more of independent of the Federal Reserve like interest rate policy. So here, many issue here given the recently traded deal between China and the U.S., something that we discussed, we hope to have a great result, which actually we did see the great outcome from there out there, and we then I would anticipate with lower tariff applied to the import from China, then the inflation might actually cool down jointly together with the layoff, cutting off the demand, and also because of the unparalleled and very disappointed government shutdown or unprecedented government shutdown. So all actually would apply the huge pressures over the holiday consumption, and then which will actually weaken the demand for industrial goods. That's why we actually saw the ISM number weaker. I would like to hear how you think, Rich, Blaine. So that's my argument from the beginning of the year. I really
Yeah, I guess I would ask out loud, I hear where you're coming from if you think that the AI will be disinflationary and in labor and we're going to have job cuts as well. That would seem to fit right within the narrative of cutting rates. But
yes,
I think if I step back and ask what good that would that really do? I think now we kind of get ourselves into that situation that we were immediately post the financial crisis where it doesn't really matter how much you cut rates, you're pushing on a string because if I don't have a job, I'm not going to buy a house, even if mortgages are lower. I'm not going to buy a new car. I won't need one because I don't have a job to go to. What is it going to spur by cutting rates? Typically, we cut rates to spur some sort of investment or consumption.
yes.
If people we're already getting plenty of investment in AI and CapEx, and that seems to be the only game in town. So I'm just wonder aloud what investment or consumption is going to get spurred by these rate cuts that the market seems to want.
Well,
I see more
yeah,
risks than I think the Fed is always looks at this in a reward to risk standpoint. I don't see the reward. I see the risks of persistent inflation because they haven't really gotten that under control yet. But I guess that's what when I look at it, I don't see what benefit would come from that. I don't think other than the fact you're trying to get lower rates because now the Mag 7 have chewed through all their cash flow and now they need to start issuing debt for a more CapEx, which is what we're seeing. Other than funding those behemoths, what benefits do we really get from lower rates?
Yeah, we see actually now that the decoupling between two largest economy in the world, China and the U.S., we also see the decoupling of the economy in the United States as well. What is apparently reflected by the ISM, the other will be we can see in the high tech, as we mentioned, Magnificent Seven. Also, we can actually expand slightly to the maybe Big Ten or something, what we call it Big Ten, including Broadcom and Palantir and so on. But now here we see two things. One sector fully focused on investing into the data center with like the human payroll replaced with the GPU that which are going to actually expand with like into the data center and also the GPU investment. So that's one side. That's by that side, they're not going to actually create a lot of a job opportunity. On the other hand, it would be something like a consumer market or consumer stable consumer discretionary market like UPS and those and Amazon or other company. So those companies are actually interest rate sensitive. What that really means is that they actually recruit a lot of people, okay, recruit a lot of the employee and with actually low interest rate. So that's could something could happen with more liquidity available that typically the CEO or the executive management might not have the huge pressures instantaneously to lay off the people to actually to cut off the capex so then not to inflate the earning per share, which they typically have a huge pressure to actually to please the investor. Now with less of the lower interest rate, then they have a bundle of the things that either they at least they have opportunity to invest into something that they otherwise they couldn't, and this would actually might actually keep the job more of the payrolls on the companies like payroll account in the sense that with actually low interest rate, the company might actually pay less in the interest payment. What that means is just like including the both the federal government, then they could actually spend the money to actually to help to pay some like food stamp and or other pay off some other benefits or something that could be done with less of interest payment. But here, so with so high interest payment, the interest rate times like the national $38 trillion national debt, that's like 35% of the interest will be at the GDP will be actually government income tax money will be actually used to like pay off the interest by itself.
Yeah, and what I what I'm hearing and what I've been thinking about it sounds like there's two types of job cuts, right? There's the job cuts that we're going to get no matter what the rate is.
Yes,
That's the AI cuts. We're going to get those no matter what. And then there's the potential job losses that we might get because the economy starts, slowing down, or just the normal kind of business cycle progression cuts that a lower rate might help with consumption to help keep those jobs or create new jobs or whatever. And I think if you're in the Fed seat, you're just trying to figure out what are we looking at here, and so we're getting these cuts now, but are they the actual cuts that we're going to get no matter what? And a rate movement isn't going to affect that rate of change, or are we at the point where we're actually getting job cuts because we're too restrictive on policy? And I'm not sure that they feel that they're too restrictive, overly restrictive. I think they probably feel they're somewhat restrictive on policy, but not overly restrictive on policy. And so I think that's, probably why they continue to take that wait and see approach. And you're hearing that debate on the, play out in the Fed itself, as Rich pointed out, with the discrepancies and the disconsent. And then it will be interesting to see in December what the rest of the committee, feels, if we're going to get more of those governors who feel like we should do no change,
yes.
quarter, what have you. So I think it's going to be interesting to watch going forward.
Um, Kind of continuing on, maybe pushing back a little bit. I mean, mortgage rates, as I have at the screen here, 30-year mortgages are down 100 basis points on the year. And we're seeing no impact on housing whatsoever. It's entirely unclear to me how further interest rate cuts are going to lead to more housing demand, because we could look back in the immediate post-financial crisis period when people also didn't have a job. If you don't have a job, it doesn't matter where mortgage rates are, you're not going to buy a house. So
Of
does this
course, yes.
doesn't seem to me that that's going to matter much. And now let's, Blaine, kind of stick with you for a second. We were talking about this before, credit spreads. Credit spreads, are not, near near the tightest levels of the last 40 years, right? Certainly in the
Yeah.
bottom quartile.
Yeah.
Um, and so, credit spreads don't seem to suggest that there's a desperate need, where there's panic in the market where we definitely need to lower rates. What do we read here? I mean, I know that, some of the things we were talking about, we've talked about the First Brands and the Tricolor and some of the other California real estate problems that we've seen. There are certainly some signs of stress, but overall, it still seems like the the credit market, the loan market is still hanging in there just fine.
Yeah, and that's all valid points, Rich. I think this chart highlights that the spreads I've seen kind of on high yield here recently were just basis points off 4 month lows, 4 month tights. So, it indicates to me a market that's still open for paper and you probably longing for paper. Same on the loan market. We've had CLO issuance that continues to plug along. I think we've even had a tick up in LBOs that have been brought to market, which we've all been waiting for the entire year. So things seem to be functioning, albeit your point on First Brands and some of these other things are things you can't ignore. In that they are probably symbolic of a bit of a loose lending environment, and you're going to in a looser lending environment, you're going to have some underwritings that get done that a year later, 18 months, are gonna surface with their problems. And I think we started to see some of that. It's just, again, we talk about pacing here. What's going to be the pacing of other follow-ons? And research that I've read and things that I'm seeing don't point to anything that stands out as raise a red flag right now. Just it seems to be a market that's functioning quite well. And and another point I was reading this morning about leverage loan prices, percentage above par have moved back higher. They had ticked back lower. I think we're like 45% of the loans now are back above par. So again, a bid for paper in a market that's somewhat starved for new issuance and actual new money to the market. So they
Yeah, and I
seem to be
just brought up the
functioning.
loan monitor, and there's
Yep.
this other one here, the fixed income credit monitor.
Mhm.
Um, just looking at these doesn't seem to be any signs of any sort of problems in the market as well. But
Yep.
Tony, maybe I'll kind of go back to you, and I think one thing I'm going to talk about is we like to look at the factors. I mean, to
Yes.
your point, the all that matters right now is momentum, large cap, and earnings revisions, right? Is really all that people care about. Um, so momentum for obvious reasons. I think your people are just holding on to what's been working, but large cap has definitely been as you've been kind of saying, earnings revisions are a big driver, and we're in the middle of that, as they have been for the last 10 years. Frankly, if you look at the last 10 years,
Yes.
momentum and earnings revisions have certainly been one of the top factors to look at. So we're in the middle of earnings right now. And why all the negativity and the need for cuts? Because if you look at earnings, the S&P, I mean, it's maybe off a little bit, but two-thirds of the way through earnings seasons, we're still getting surprises, and around earnings surprises 5% better than expected. Sales, a little over 2%. And on an absolute basis, earnings are growing at 11% and sales are growing at 8%. That doesn't sound to me like a sharply negative kind of commentary, to where we even need to cut rates.
Correct. So we are seeing some kind of structure, these inequality here due to the AI. What that really means is that as as the overall wealth of the society continue to grow, and very small group of people here is large cap, especially large cap tech, accumulated more than 80% of the wealth. That's like a additional created. And then with remaining maybe like 90 or 95% of the company or the human personnel only accumulated the rest of the 20 or 15 of the additional wow. So that's why in general, if we actually look at the overall market looks super strong and similarly looking at the uh, I think fixed income market, there is no stress over there. That is telling us the market does not see a recession coming up over the next 2 quarters. So that's how I interpret in that sense. That probably might be right. Over this coming quarter and the beginning of 2026, we might not actually see the recession kicking in, given the strong momentum of the AI so far. And simultaneously, that actually have a huge impact over the remaining of high interest rate, have a huge impact over the sustainability of the company, mid cap and small cap, which actually represent 85% of the market or company by themselves so far. So that's actually being said is if we actually just looking at the index performance, looking at companies like performance, we probably think everything's just so fine, but internally, just we are going to see this proportion in inappropriate dis disparity within different sector. So here, tech sector apparently favored by the investors significantly, but not those kind of defensive sector, healthcare, financial sector, real estate. This is a great point you actually brought it up. So even though the Federal Reserve continue to lower the interest rate, but the demand for the house hasn't really increased dramatically, and we continue to see the rate going down, and it's actually quite straightforward. It's not if we look at the Middle West, this is like where the people might continue to actually suffer given the high interest rate environment. That's why I advocate the Federal Reserve take a more of a preemptive cut, like to help people live in the Middle West, not just a few large cap tech, even though large cap tech turn out to be my favorite investment, my favorite sector, right? Even from the beginning of this year, that I keep mentioning that. But overall economy, farmer is in the Middle West actually suffer significantly over the past 2 months without China buying single tons of the soybean, right? But started buying. So you can see this is disproportionate influence over there. So that's my take on this, Rich.
And these onerous mortgage rates that are hurting people in the Middle West of 6.25%. We had those same mortgage rates in 2004, 5, 6, and
Of course.
7. We had a housing bubble. So
Yeah.
it's not, I don't think it's the rate itself that has caused any problems. But I'm glad you talked about how, you talk about the breadth of earnings. If I look at it, 9 out of 11 sectors are showing pretty strong earnings growth here. And if we look forward, that earnings growth is expected to continue through next year. But I'm really glad you brought it up because if I bring up the Russell 2000 earnings growth, it's been over 20% this quarter,
Yes.
almost 21%. And yeah, technology is up there, but it's not even the technology is not even the best performing sector in terms of earnings growth within the small caps. We are also seeing energy, small cap energy doing well, small cap materials doing well, small cap financials doing well. There's a lot of other sectors that are doing well out there, yet the market doesn't want to pay attention to it because of perhaps because of the passive index and the passive drivers, which is leading to the momentum bid. But Tony, or sorry, Blaine, I want to move to you. It seems to me that even though there's this strong narrative that only the large cap tech will be the winner here, we're seeing actually in the performance from earnings standpoint, a lot of sectors, large and small, seem to be doing okay, and people seem to be ignoring that. As I wrote about on LinkedIn today, haters are gonna hate, but it seems to me like the performance that we're seeing is pretty impressive and pretty broad.
Yeah, especially with the narratives that we were facing earlier in the year. I think when you put all of this in context, what we thought, back in April versus what we're seeing now, you it, it, it's an impressive outcome. How these companies have continued to manage with some uncertainty and as far as their business model. Tony just mentioned the China-US tariff talks and negotiations. I mean, there's been so many headlines, but yet you're right, it's been broad and companies have continued to find their way through. And again, when you look at this chart, you're outside of what healthcare and consumer discretionary. Everything else here on the earnings growth side is kind of up in a way, maybe a little bit on real estate, a little bit lower than the mean. But yeah, I'd agree with you, Rich. Markets have been robust and strong.
And then one thing when we talk about these risks, I think the equity investors are seeing risks now that bond and FX investors are not seeing, and that's kind of very different than the what we've seen really for the better part of the last 12 months. The last 12 months, we've seen the more quote macro markets of FX and treasuries. I'm looking at the MOVE index, which is the Treasury VIX, and the JP Morgan G7 FX vol index have been consistently at levels above what you'd expect um, relative to the VIX and credit spreads, which are more idiosyncratic markets. Yet we see the VIX kind of volatility ticking higher. Equities are seeing some risks in the market, but the more macro markets are saying, no, nothing out there, nothing to see here. We're actually climbing the wall of worry. We're getting past and we're getting through some trade deals, et cetera. Maybe the equity market's being a little too pessimistic. What do you think, Tony? Is the equity market broadly speaking being too pessimistic right now?
I
Is there
I wouldn't call it too pessimistic. And if we actually look at how much that the market actually has rallied since the bottom in the Q1, right? Pretty much already, if looking at the S&P, almost like a 40%, and you've large cap tech, NASDAQ is like more than 40%. This is extraordinary from any single point of view, given the history of the U.S. stock over the past 10 or 20 years. So this is a phenomenal. And what anything that picking up over here, that might just indicate that a lot of investors are a little bit about anxious actually to be more cautious to protect their gain rather than actually seeing a huge issue here. Apparently, some bears do actually cause something that a developer do cause our concern. For instance, like we see the circling of this Magnificent Seven plus OpenAI, Broadcom, they actually have some kind of a circling transaction here, with OpenAI committed of buying 300 of billions of dollars of GPU from NVIDIA and simultaneously having a bunch of the deal which actually had not been materialized. So it's all about the AI talk. So here would lead to both the academia and also industry to actually to question the legitimacy of this kind of a circling transaction. This is definitely concerning over here. That basically saying right now the market has a price in the full adoption of AI, given to say, hey, right now there are roughly only 13% of the US corporate have already adopted the AI into their regular process, even though more than 80% of the company has already mentioned or comment about the AI in their earning announcement report. But here we still see a lot of exactly us thinking about how the AI can increase the productivity or simultaneously to replace their existing human being to save the capex or opex. So, given there's a multiple factor continued developer here, apparently a lot of people just institutional investor are questioning about the legitimacy of the circulating trade deal. I want to actually hear how you think, Rich Blaine. So when actually you see the company like uh, making some $100 billion of a commitment or either investment with the money that they don't even have, what do you think?
Blaine, what do you think when you see a company like let's just say something that might you refer to as a Mag 7 name that is seeing its status quo business get completely disrupted by this new technology called AI, and they're investing all of their free cash flow into GPUs, and not only that, but now they're coming in and saying, "Hey, Mr. Credit Investor, give me a loan because I've gone through all my cash flow. Now I need a loan." To buy some more chips that have no shelf life whatsoever. What would you say, Blaine? You're
Yeah,
an
that
investor.
you
Would
hit
you
you
say,
hit both you hit both stage one and stage two. You've got this enormous announcements of CapEx spend here in the last couple of weeks by these companies. that have historically generated large amounts of free cash flow. They have a lot of cash on their balance sheet, and now all of a sudden they're saying that we're going to spend on CapEx at a rate higher percentage wise than what we're bringing in revenue growth. So that's like a new narrative to me. Not that these are large companies, and obviously they're not in fear of going bankrupt overnight, or not being there tomorrow. They have a real business, but that is a new narrative. And then what you just mentioned, Rich, is the idea that now some of these companies are going to be tapping the credit markets to fund, some of this CapEx spend. Just again, to me, I don't disagree with a lot of what Tony is saying. We're not going to put the AI genie back in the bottle, and I think we're just kind of scratching the surface of what it's going to mean. It's going to be more than the chat bots we're seeing now, but the amount of money that's being spent without yet any way to understand the revenue that's going to hang off of it coming back, and then you're going to tell me that you're going to need to tap the credit markets to spend even more. And then you're probably going to need to continue to do this. What type of cycle is that going to be? Is that every 18 months you're going to reconfigure these GPUs and servers and, data rooms and everything? What what is that revenue that's going to come back and make these investments that ROI meaningful? And we don't know what that is yet. And so, your chart, Rich, about maybe the VIX being a little bit higher coming into the end of the year. You've looked at all the profits that have been made. So maybe, some folks are just saying we take some money at the end of the year off the table and are kind of, positioned against that slightly negative outcome, so to speak. But yeah, there's a lot of unanswered questions for me, given the amount of spend that's happening.
I mean, you don't want a bunch of NVIDIA Blackwell chips as collateral on that 10-year loan, given that they're not going to work in a year.
Well,
Yeah, I don't know why you'd want that. I mean,
and not to get too much off on a tangent, but it seems like they're all buying from each other. And that's the other thing that I don't quite get is it's like, we've all got agreements with each other, and how to trace that through, and really, how does this all stand up on its own two legs? I think
but
that's to be determined.
I think Tony brought up a point before that I think I've kind of made, and I look at Oracle as the poster child for this,
Yeah.
is that a lot of these companies will, to me, my interpretation, Tony, tell me if I'm wrong, my interpretation is they look at AI as an existential crisis, and that's why I say Oracle is the poster child, because Oracle's legacy SaaS business is going to go away with AI.
Yes.
Oracle knows this. Oracle, and how do we know Oracle knows this? Because they're firing all their legacy SaaS people, and they're going all in and not only investing all their free cash flow, but 2/3 of their revenues into AI. And because they know that there's two choices: either they're going to do nothing and go away, or they're going to make an investment with it, odds that it all fails and they go away, or odds that they're successful and they stick around. So to me, it's an existential crisis, and they know that it's a winner take all environment, and so you have to be either in first place or second place. And so I think there's a little bit of a of partnerships forming and consortiums forming so that they are in the winning team, if you will. But it seems to me like there's a lot of games theory, gamesmanship going on right now, trying to be one of the one or two platforms that survive on the other end, Tony. But I'm
Well,
going to give you the last word on that one.
Well, yeah, yeah, yes. I mean, even though I continue to advocate that AI might be the last innovation in the mankind history, however, when actually looking at the circling transaction between among these few companies are still actually quite concerning to me. One way to argue for that, as what you point out, Rich, that we are going to see, oh, maybe just a winner take all, then the circling like transaction among like OpenAI are going to buy the 300 billions of the service or product from Oracle, while simultaneously making having a loss about more than 10 or 15 billion dollar a year. That's actually doesn't that does not sound sustainable. And when he actually questioned that from a rational investor, when if an investor is really rational, then they actually throw in another like a fireball to say, okay, OpenAI is going to actually sign a 100 billion deal with AMD. And then you suddenly just open up your eye. Where does the money actually come from? Okay, now you can say, okay, oh, if you actually OpenAI sign out the deal, that the money actually will come back will be the NVIDIA is going to actually providing the funding for OpenAI to actually to purchase the product GPU from AMD and purchase the service from Oracle. And where does the money actually from NVIDIA actually come from? NVIDIA say, hey, OpenAI and Meta are committed to buy the GPU chip from me. So you can see here, it all depends on whether the whole supply chain are going to work and eventually who is actually going to pay for the return of the AI adoption. Maybe the taxpayer, or would they be the one who will be paid out in the like dot-com bubble or in the 2008 global financial market? Here those companies are becoming too big to fail. Literally, are too big to fail,
Yeah,
right?
the good thing
So
is if I don't have a job, I don't have to pay any income taxes, so I won't be down. So it's
yeah,
that. And it does sound a
yeah.
lot like a Ponzi scheme for sure, lending your
When's
money
the
to
ad-based
your customer
GPT model
money.
coming?
Sorry.
Exactly. So apparently, like the UBI, Universal Beneficial Income, is getting like harder and harder in both industry and academia, and even for the government to really think about whether this might be the case. But AI had become the national security issue for both the United States and China. So no single country can afford losing in this AI battle. This is certainly something for sure.
So certainly something to talk about later, but just to wrap it up here, I think this potential AI Ponzi scheme is maybe why I'm showing the put call, just my favorite short-term indicator, the overall market put call ratios. We're definitely seeing a demand for hedging here as we're kind of getting through earnings, and we're not seeing any very good price action. Even though we're seeing good earnings, we're not really seeing good price action, and so that's why I say maybe the equity market's a little pessimistic because the earnings have been good but stocks are not reacting to that really, and we're actually seeing a pickup in hedging. But what I'd like to leave you with is as we look into November and December, November and December are, November in particular is over the last 15 years is the best month historically. And December is also positive. And, when we look at 12 of the last 15 years, November's been positive and it's got the best returns of any month of the year in the S&P 500. And I know, Tony, you'll say that that's all because of large cap tech. But then I present to you the Russell 2000, which has even better returns than the S&P 500, and is also positive in that number of years and outperforms the S&P 500 in both November and December. And so you wonder where these concerns that we're bringing up may be 2026 problems, but in the short term, it does feel like there's probably more upside than downside because earnings are coming in better than expected. Momentum is still a strong factor, and the seasonals are looking pretty good. So, Tony, I'll go to you, and then Blaine, I'll give you the last thoughts on for our listeners what we should be thinking about, at least for the rest of the year. That we've got 8 weeks left in the year. How should we be thinking about some of the issues that we talked about?
Well, with Federal Reserve still having some kind of weapon in their hand, we might still have a much larger probability to see the Santa rally coming forward through the end of this year. But with a lot of uncertainty given the different candidates over the Federal Reserve in the coming year 2026, and also when the concerning factor of layoff from the big corporation and throughout the main street, I would actually be very, very cautious and a little bit anxious over the performance in the Q1 2026. But let's actually enjoy the rest of the year, which actually turns out still to be very strong double-digit return for both S&P large cap. So hopefully with the tariff settlement between China and the US, hope the inflation might actually come down and more people, more investors might be better off to spend to buy cheaper stuff to celebrate the holiday.
Blaine, last words for you.
Yeah, for me, a little bit on what Tony was saying, but certainly I'm gonna be watching some of the Fed speak post the meeting we had last week, just to get an understanding of kind of what thoughts are on the overall panel. To have a better understanding going into the next meeting, what we might be seeing. I think the rest of the earnings season, pay pay attention to that. And I think what you were alluding to just at the end, Rich, about some of the, maybe hedging going on at the end of the year with the run we've had and folks just, wanting to protect some of those gains and maybe that adds some volatility to the market. But those things I'll be watching.
Well, Blaine, Tony, thank you. Thanks for joining me. Thank you to everyone who's stuck with us this far and listened. Once again, we're going to talk AI. We're probably going to talk about AI in every podcast that we have. And I can't believe that I'm arguing that the equity market's too pessimistic, given what I've been arguing all year. But it does feel like the path of least resistance may be higher. So with that, we'll look for to get back together in another couple of weeks and see how the Santa rally is progressing.
Yeah, thank you, Rich. Yeah, thank you, Blaine. Yeah, definitely looking forward to Santa Rally.
Yep. Thanks, Rich. Thanks, Tony.